Hi, thanks so much for joining in. You're watching the Mutual Fund on a show on NDTV Profit. My name is Mathew. Like the name suggests, this show gets you actionable insight on everything related to mutual funds. And often we talk about the way that mutual funds are managed as well. So today, one of the primary focuses is going to be a potential change, something that might just be in the works, and how that will change portfolio construction or approach to portfolio construction by fund managers. We're joined by Chirag Mehta, who's the CIO of Quantum AMC, and we will soon be joined by Nikhil Kothari, who's the director at Etica Wealth. Chirag, thanks so much for taking the time, and pleasure speaking with you on NDTV Profit.
Thank you for having me. Pleasure to be here.
So we're having what is very obviously a hypothetical conversation right now, because there is a source-based report out there that suggests that there might just be a bid or a suggestion by the industry to the regulator to reclassify the market capitalizations and the definitions of large cap and mid cap. Currently, you have large cap is defined as the first 100 stocks and mid cap as the next 150 stocks. But the reasoning that has been given is that we've seen a significant rise in the market since COVID-19 lows, and what was a large cap then is in fact a mid cap right now. So what I'm trying to understand in this conversation is, would this materially change the way that you approach portfolio construction, and why is this a requirement? So that's the first question, Chirag.
Yeah, so the argument you just laid out that, given that some large caps would have become mid caps. So from that construct perspective, still it is a subset of 100 stocks, right? A large cap is still 100 stocks, mid cap is still 150 stocks. So number of stocks may have moved from one end of the curve to the second end, but overall still the subset remains 100 and 150 stocks in each category. The issue is that large cap funds have a restriction of 80% to be held in large cap stocks. And therefore, given that there is a churn, for example, last year, we saw a churn of 14% moving from large cap to mid caps, which from that perspective leaves little room for fund manager to have enough flexibility to kind of rebalance their portfolios. So there will be some, say, 3 to 5% cash for liquidity purposes held by the fund. There will be churn that will result into that 14% impact in terms of changes in allocation. So to meet that 80% threshold becomes to that extent difficult when market dynamics are pushing many stocks from large cap to mid caps. So I think from a large cap perspective, there is a need to have some more flexibility moving into the threshold levels. Like 80% is a high threshold level to achieve when market dynamics are changing very, very fast. In years when you have churn ratios of 2 to 5%, probably that's easier. But when you have churn ratios which are very high because of market cap changes, that leads to relooking at the classification. But however, for mid and small cap funds, there is a leeway of 35%. So from that perspective, there is enough wiggle room for these funds to maneuver out and ensure that they meet those thresholds. But for large caps, probably there is a room or a merit in relooking at the classification the way it's given today.
So if you do hypothetically change the classification and you have, instead of 100 stocks, you increase it to 125, for argument's sake, Chirag, from my perspective, the challenge of that would then be, how do you benchmark it? Because right now you have a lot of funds in the large cap actively managed space that benchmark to the BSE 100. But if you change the base or the pool from which you choose the stocks to 125, would benchmarking then become difficult?
Not really, because if you see, benchmark is just a barometer of what that space is doing, right? So if you have a pool of 125 and you benchmark to 100, still it occupies much of the market cap that lies in the 125, maybe leaving around 10% away, additional for that 25 stocks. So overall, you still will be capturing 90% plus of the market cap, even if you compare with a pool of 125. Similarly goes for example, small cap. small cap has about maybe 4,000 stocks, and you are benchmarking to 250 stocks. Is that good enough or not? So I think benchmark acts just as a barometer, and 125 stocks benchmark to 100 stock index. I think that still justifies because it captures much of the market caps available there.
Okay, so I think that more or less covers that topic. But while I have you with me, and this is something that I like to do with all of the representatives of funds that speak to us on this particular program, is to try and understand how your portfolio construction works. Would you be able to describe the ethos that you follow when you're selecting your stocks?
Sure, and I will relate it to the topic that we are discussing. Much of the requirement for flexibility emerges when you have, say, funds AUM rising much more than the market cap and liquidity of the underlying pool that you're tracking. For example, the mid and small cap have, increased, the fund size have increased by about 250 to 350%, anywhere in that range. Whereas if you see the market caps of these companies have only risen by about 230%. So that is over last 4 years. So if you were to look at why these flexibility requirements are emerging now, is because the fund sizes have crossed the capacity levels to some extent, of which they can deliver a meaningful portfolio, keeping into consideration the market cap and liquidity requirements that are needed for managing these strategies. And that is where you have that ask, to relook at the classifications. So at Quantum, we are very, very aware of the market cap and liquidity criteria. So in our large cap oriented offerings, we kind of look at liquidity as one of the first criteria to filter out stocks. So any stock that trades only a $1 million a day on a liquidity over last 12 months is only included in the universe that we track, so that we can, scale the fund to a size without compromising on the portfolio characteristics of the fund. Another thing that we look at is governance is very important criteria. If governance is not up to mark, we would not invest into those companies. And thirdly, from a valuation standpoint, it should make sense in terms of the upside it leaves on the table after normalizing the numbers over a period of time. Because in a bull market, it's easier to get carried away. Whereas if you normalize numbers, probably it gives you a realistic picture. So those are the things that we look at: liquidity, governance, and valuations as a predetermined factors that should tick when we select a stock.
Okay. So that gives me an overarching framework. But when you look at the market, and this is essentially my last question right now, if you look at the valuation picture right now, are you sanguine? Are you comfortable? Are you holding more cash in your portfolios right now? And will that be your approach in the near term?
Yeah, so valuations are getting expensive by the day as markets keep moving up. Companies are delivering good in terms of earnings growth. So we are seeing that support from the market, and therefore long term, if you look at the P ratios of index, are slightly above only over the long term averages. But given that we are bottom up stock pickers and we look at stock specific ideas, we still see some room for our portfolio to provide some upside in stocks. So yet, we haven't increased our cash levels as yet because cash is just a residual of our process, and we still see upside in our stocks. So we are staying put at this point in time. But if markets keep rising, probably we'll be compelled to sell because there'll be no upside left into those stocks, and therefore our cash levels may rise. But at this point in time, we are still looking at more upsides from our portfolio companies.
Fantastic. Chirag, thanks so much for joining us on the Mutual Fund Show. Pleasure speaking with you. All right. And by the way, Nikhil's joined in the interim. Nikhil, thanks so much for joining us. We will have a conversation about arbitrage funds as related to systematic transfer plans, because as Chirag just pointed out, valuations in certain pockets are getting just a tad bit stretched. So we will take that up after a very quick break. Viewers, do stay with us. Welcome back. You're watching the Mutual Fund Show. Now, a few market watchers have pointed out that valuations in certain pockets of the equity market are a little stretched. Now, from the perspective of a retail investor then, you need to be a little bit cautious when you're deploying large sums of money. How do you maneuver in this scenario? You usually use an instrument, or rather a method of deploying funds called the systematic transfer plan, that allows you to invest in a particular scheme of a mutual fund, which then deploys funds periodically into another scheme of that same fund. That's the definition of a systematic transfer plan. We'll talk about how you should employ this and in which situations you should employ this. To talk about this in more detail, I've got Nikhil Kothari of Etica Wealth joining in. Nikhil, thanks so much for joining us on the Mutual Fund Show. I do want to start, before I get into STPs and how you use it, I want to get into the fund that you use to use that STP, which is traditionally a liquid fund or a fixed income fund. But the taxation or the tax treatment of these fixed income funds has changed. So from that perspective, should you rather use an arbitrage fund because of the tax advantage, and what do you need to bear in mind? So the first question is, what is an arbitrage fund?
Okay. So arbitrage fund, as the name speaks, it gets an arbitrage opportunity that there may be a price difference. So basically, on last Thursday of every month, the future market price and the cash market price become same. So what arbitrage fund does is that they buy in cash market and immediately sell in future market. And whatever is the difference is the return which they will make. Okay. And in the last few months, what we have seen is that the spread, the rollover spread has increased, and arbitrage fund are giving return upward of liquid fund returns also. And since whenever the markets are volatile, you get a lot of arbitrage opportunity. And arbitrage fund keeps on deploying in those opportunities and making a return which is a risk-free return if you hold the position for the whole 1 month. So there's no risk on the downside, and it gives you a risk return if the fund holds the position for one complete month.
Understood. Now, the question that I need to ask is that because the management of the arbitrage fund is in the equity markets, and you're talking about buying in cash and selling in futures, so therefore the underlying is equity. The question is there a risk of capital loss, and is that something to worry about at all? And what is the degree of volatility of returns that you will get from an arbitrage fund? What impacts that return?
Okay. So basically, see, if, as I discussed, that what they do is that, say for example, the cash market price, Reliance shares is trading at say 3,000 rupees, and in future market price, so that which say last Thursday of the month, and the future market price is 3,100 rupees. So what the fund manager does is that he buys in 3,000 and immediately places an order to sell on futures market in 3,100 rupees on last Thursday of every month. On last Thursday of every month, whatever the price, if for example price goes to 3,500, he makes 500 rupees profit in the cash market. He makes loss of 400 rupees in the futures market, and overall his gain is 100 rupees, which is logged in when he did the transaction. So in a whole month, if the positions are rolled over, there's no concern of making a capital loss. But during the month, what can happen is that the future market price can go up and can go down, and the cash market price also fluctuate. So because of that, in between, arbitrage fund may show you some volatility in terms of return. But if you hold for the whole company, when the position gets closed on the last Thursday of every month, the cash market price and future market price become same. And whatever price you have done the transaction the first day gets logged in the same thing. So you don't make any capital loss if you hold the position for the complete 1 month. So you don't have to worry about the loss of principal. What you need to worry about the interim volatility, because if you say, for example, invested and only invested for 15 days, you may see some volatility in the return. But over a 1 month period, you get return in line with your liquid fund returns.
Okay, but at the same time, the tax treatment is equity, right? So what does one need to bear in mind? Usually, it's short-term capital gains, right?
So yeah, so if you're doing STPs for short period of time, then basically you will be redeeming all your money in less than 1 year. So in that case, it becomes a short-term capital gain, and you only pay 15% tax on that. Okay, but if you're doing long-term STPs, and say for example 2 years, 3 years, okay, a lot of people like to right now keep money for 15 months and 20 months to do STPs. In that case, the whatever money is invested in arbitrage today, and if it completes after 1 year, and when you do the redemption, when you do the STPs, that tax rate will only be 10%. So effectively you pay 15% or 10% as compared to debt fund where you pay 30% if you fall in the highest tax bracket, or if you fall in the even higher tax bracket, you pay 30 to 40% tax as per your marginal tax rates.
Got it. Let's also talk about STPs and the use of STPs. It's not necessary that it is always beneficial to do STPs. And of course, this SIP Sahi Hai campaign, I think, has been bought into by a very large number of people. It has worked as well. STP is a more nuanced approach, wouldn't you say? So what, according to you, is the ideal window in which you should deploy using STPs, and in which scenarios should you use STPs? Is the current scenario something that is appropriate?
Okay. So STP is basically, SIP is a different concept altogether, because I earn every month. I need to invest every month, and that's where the SIP concept comes in. But what is STP? When we use STP, when I've got a large sum of money, it can be bonus, it can be any large, if I sold any investments and I got a large sum of money, and I need to invest in equities. Okay. Now, normally, if we all know that if you invest in equities and hold for 10 years, you make very good return. But many times valuation also plays a role, that when you should be investing lump sum money in equities and when you should be staggering your investments in equities because the valuations are stretched. So when you're doing STPs, you need to understand that whether the markets are cheap, markets are fair value, or markets are expensive. If markets are very cheap, then you should not be using STP. You should be investing your bulk money in equities at that point of time. So for example, if you take the COVID times, when markets were corrected by 15, 20, 30%, that is not a time to do STPs. You should be investing lump sum money. When markets are fair value and you believe that there can be some event in the short term and it can be volatile, you can do STPs for 5-6 months, right? But if you believe that markets are really expensive or the valuation are stretched, I believe in the long-term story of the country, but because there may be some volatility in the next 6 months, 8 months, and there are very big events coming in terms of elections and earnings. So in that case, what you do, and because you're not very comfortable investing your lump sum money in equities at that point of time, you should use STPs. So you park in debt for arbitrage fund, and that from there you can take a every month date, and you can keep on doing STPs every month to a pure equity fund. Now, over and above STPs, you should also be using something called a switch. So when you believe that markets are corrected by 10-15%, and those point of time, you instead of only waiting for STPs to keep on going, you can switch your money from arbitrage or debt fund to equity fund at that point of time. So you use STP when you believe markets are expensive. And as you have already heard, that last speaker was saying that markets in some pockets are really expensive, and more specifically in mid and small cap space. So if you want to invest in mid and small cap space, there can be some volatility next 1 year, 1.5 years. So in that case, I won't recommend that you invest your lump sum money in those counters right now. Rather, you do a staggered approach of investing in these funds in the current junction.
Okay, fantastic. Now, I did promise at the start that I would take some queries, and in fact, we've got a few viewers that have written in on the WhatsApp number that you can see on your screen right now. Parikshit Kulkarni has got the first question, and he's got a two-part question. The first one, he's listed out a couple of schemes in which he is investing in through SIPs, and this is since 2017. He's got the ABSL Focused Equity Fund, which he's doing a 6,000 rupee SIP in, and he's got the UTI Mid Cap Fund as well, in which he's doing a 4,000 rupee per month SIP. The total value of that currently stands at 17 lakh. The question is, should he stop the SIPs or continue for 15 more years? If yes, which one should I stop, and which new mutual fund scheme should he look at? What's the view here, Nikhil?
Okay, see, both these funds are good in their respective categories. In recent times, they would have underperformed their peer group is more because the allocation what they have. So ABSL Focus Equity Fund has a large component of biases towards large cap, whereas if he's comparing to his peer group, there may be a lot of funds which have got a middle small cap, and because of rally in middle small cap, ABSL Focus Fund has slightly underperformed its peer group, and same goes for UTI because this fund also have got 25% in large cap space. So what I rather recommend right now, these funds are good, they're managed by a good fund manager. You can hold on this fund, not redeem in this fund, because in mutual fund there will be phases where one fund will underperform, okay? But every 2 months or 3 months underperformance should not be lead to your changing the funds, because ultimately when you hold the funds and stay invested for 10-15 years, then only you make return. So I'll say that you should continue to hold on this fund and just stay invested until you see a change in fund manager and change in philosophy. Then you should be changing the fund accordingly.
The second part of his question, and he's asking about more SIPs that he's doing. He's got Kotak Emerging Equity Fund, 5,000 rupees per month. He's got ICICI Pru Multi-Cap Fund, which he's doing 5,000 rupees per month. And he's got recently started SIPs. He's got the Nippon India Multi-Cap Fund, the SBI Large and Mid-Cap Fund, and the Parag Parikh Flexi Cap Fund, all of which he's doing 5,000 per month. So he's doing quite a lot of investments. He's asking, since he already has 2 multi-cap and 2 mid-cap funds, should he add another large-cap fund, and he wants to invest a lump sum of 15 lakh? Should he invest in these SIPs in a staggered manner, or in another, or how does he do it? And I think that the STP conversation we had earlier is relevant in this scenario. So one, should he add another large cap? And I've got a question on this. He's got a lot of schemes. Should he reduce the number of schemes?
Yeah. So first of all, adding more funds doesn't make any sense in his portfolio because he already has a lot of schemes. And if you look at his portfolio, as I discussed, Birla Focus already large cap, have a good large cap exposure. Parag Parikh Flexi Cap also have a large cap exposure. SBI large and mid cap will have 35 to 50% in large cap. Multi cap will also have a large cap exposure. So there's no point of adding any more large cap fund in his portfolio. So I will not recommend to add any more funds in the portfolio. Consolidating portfolio, he can do that because he already have an ICICI multi-cap, so it doesn't make sense to add Nippon India multi-cap again in the same category. So I would rather recommend them not to add any more funds in the portfolio. You can consolidate ICICI multi-cap and Nippon multi-cap to one multi-cap fund instead of having two funds. And rest of funds he can continue the SIP as is what he's doing now. And incremental SIP also, if he wants to add, he should add in the similar funds. With regard to lump sum investments, as we discussed already, that it's a good time to do staggered investments instead of putting lump sum money. So he should do STPs, and currently he can look at Parag Parikh Flexi Cap, SBI Large and Mid Cap, and if he wants to add Mid Cap, he can either do Kotak Emerging or UTI Mid Cap and invest in the existing scheme only in a staggered manner.
Okay, I do want to ask, and I forgot to ask you about this. Arbitrage funds is what we discussed as an option to use, but which arbitrage funds, in your opinion, should be looked at? Of course, if you're looking at an STP, you should essentially be doing the arbitrage in the same scheme. So the other question is, you've looked at all of these schemes. Which of these, if he has to consolidate and if he has to reduce the number of schemes, which can he move?
Okay, so first on the arbitrage, I will also highlight one more point. One is that why arbitrage is right now making even more sense is that earlier, I'm saying long back, we had T+5, then we came to T+3 settlement date. Now, then we had T+2 settlement date. It used to take 3 days time from money moving from arbitrage to equity fund. Now we have T+1 settlement date. So basically the money moves in 2 days time itself, right? You have a trading date rate, next day there is settlement, and third day money is in your in the designated +0 settlement date. So in that case, the arbitrage fund and the liquid fund will remain more or less similar in terms of when the money gets switched in terms of time frame, when money gets switched from debt or arbitrage to equity fund. So that way the arbitrage makes more sense. With regard to when you're doing STPs, you have to select the arbitrage fund from the similar fund house from where you're doing the STPs. Otherwise, I'm saying in arbitrage fund, there's not too much of research. What you need to know is that arbitrage fund should be consistent, okay, and they should not be volatile. And the fund house should not take a naked equity exposure. They should all the exposure to equity should be pure arbitrage opportunities.
And, okay? And finally, very quickly, which should he move out of to consolidate?
So ICICI multi-cap and Nippon multi-cap, he can either choose one fund and doesn't make sense to have two funds. A rest of fund he can continue as of now.
Fantastic. All right, Nikhil, thank you so much for joining in and for giving us that answer and speaking to us on arbitrage funds as well. That brings us to the end of this particular edition of the Mutual Fund Show. It's been a pleasure bringing it to you. Do stay tuned. This is NDTV Profit.